Central bank digital currencies, CBDCs, are digital forms of a country's official currency issued and regulated by its central bank. Unlike cryptocurrencies like Bitcoin, CBDCs are centralized and backed by the government. They're designed to work alongside physical cash and traditional bank accounts or even replace cash altogether. Countries like China with its digital yuan are leading the way, while the United States and the European Union are still researching and conducting pilot programs. CBDCs are being developed for several key reasons. First, they promote financial inclusion by providing low-cost, accessible financial services to unbanked populations. Second, they increase efficiency and reduce costs associated with printing and securing physical cash. Third, CBDCs allow central banks to maintain control over monetary systems amid the rise of private cryptocurrencies. Finally, they offer new ways to enhance monetary policy. CBDCs transform monetary policy in several ways. Traditionally, central banks influence interest rates to control inflation and economic growth, relying on commercial banks to pass changes to consumers. CBDCs offer a more direct mechanism. Central banks could adjust interest rates directly on CBDC balances held by the public. For instance, negative interest rates could encourage spending, while higher rates could promote saving, making monetary policy faster and more effective. Real-time money supply management is another significant advantage. CBDCs provide central banks with real-time data on the velocity and circulation of money. Unlike cash, which is difficult to track, every CBDC transaction leaves a digital footprint. This allows for better monitoring of the economy and quicker responses to crises or inflationary pressures. Real-time data can also enable central banks to analyze consumer spending patterns more precisely, providing more granular control over policy adjustments. CBDCs also enhance liquidity and stability management. In economic downturns, central banks could distribute CBDCs directly to citizens as a form of helicopter money, bypassing intermediaries like commercial banks and stimulating demand more effectively. Imagine receiving direct digital stimulus payments ready to spend instantly. This is a possibility with CBDCs. Unlike traditional bank transfers, CBDCs would eliminate delays and processing fees, making monetary interventions more impactful. Cross-border payments represent another key area of transformation. Traditional international money transfers are often slow and expensive, involving multiple intermediaries. CBDCs could simplify this process, allowing instant, low-cost transfers between countries. This could significantly improve remittances and global trade efficiency, providing benefits to businesses and individuals alike. However, CBDCs come with challenges and risks. One major concern is privacy. CBDCs could enable greater surveillance of financial transactions, raising worries about how governments might use or misuse this data. Striking a balance between privacy protection and regulatory oversight is a critical challenge that policymakers must address. Privacy-focused CBDC designs, where user identities are protected unless flagged for specific reasons, are being explored to mitigate this risk. Additionally, widespread adoption of CBDCs could disrupt commercial banks. If consumers hold most of their money in CBDC accounts with central banks, traditional banks could see reduced deposits, impacting their ability to offer loans and requiring a rethinking of their role in the financial system. Some proposals suggest a tiered system where CBDCs coexist with traditional banking to avoid destabilizing the financial sector. Cybersecurity is another critical risk. A breach in a CBDC system could have catastrophic economic consequences. Robust security frameworks are essential to prevent attacks on these digital infrastructures. Countries developing CBDCs must invest heavily in resilient technology and contingency plans to manage potential cyber threats. Several countries are leading CBDC initiatives. China's digital yuan has already been tested in major cities and events like the 2022 Winter Olympics. The European Union is working on a digital euro to create a secure and efficient payment method that preserves privacy. The Bahamas Sand Dollar, one of the first fully operational CBDCs, aims to improve financial inclusion across the islands. India, too, has launched pilot programs for a digital rupee aimed at modernizing its financial system. Looking ahead, CBDCs open the door to innovations like programmable money. Central banks could set conditions on how and when digital currency can be spent. For example, stimulus money could be programmed to expire if not used within a set timeframe, encouraging timely spending to boost economic activity. Programmable money could also be tailored to specific purposes, such as funds restricted to purchasing certain goods or services, enhancing the precision of fiscal policies. CBDCs could also integrate with blockchain technology for greater transparency and security in certain use cases, though this would require careful regulation. The potential for smart contracts, self-executing agreements, within CBDC frameworks adds another layer of innovation, automating complex financial transactions without the need for intermediaries. New monetary tools could emerge, leveraging real-time data and programmability to manage inflation and economic growth more dynamically. However, striking a balance between innovation and control is crucial. Policymakers must ensure CBDCs enhance financial systems without compromising privacy or stability. There is also a need for international cooperation to create standards and interoperability between different CBDC systems, fostering a more integrated global financial system. In summary, CBDCs represent a fundamental shift in how money works, offering powerful new tools for monetary policy and financial management. As countries explore these digital currencies, they must navigate complex challenges to harness their full potential while mitigating risks. The evolution of CBDCs will shape the future of finance, and staying informed about these developments is critical for understanding the changing landscape of global economics.